lot of investors right now and ordinary people are desperately keen that when the pandemic ends, they'll go back to normality. And they assume that normality might mean an economic recovery and some kind of political peace. We'll go back to the kind of analysis of the economy that everyone's taught about at MBAs and things like that. But I think that assuming that political risk is going to disappear after the pandemic is probably a big mistake, because we've seen the government intervene in the economy to an astonishing degree during the pandemic. The question of how it does or does not roll that back could prove to be very politically divisive. And the other huge issue is that if we do have a roaring 20s, how will the fruits of that be distributed? Because the pandemic has revealed tremendous gaps between winners and losers, both inside countries and between them.
So, Peter, what about as an investor? As I say, in 2020, this may be oversimplifying it, but it was basically be in the market, you'll do fine because the government's going to bail you out. Now we're in a different world as we look into recovery. How does an investor take into account what the Fed may or may not do? Jay Powell seems to be saying just let them play right now when it comes to the 10-year yield. And then we have more spending coming out of Congress. How does an investor take that all into account, or do they?
We've been through 30 years of declining interest rates. Let me give you a couple of facts that I think is interesting. Over the last 10 years, inflation is 1.7%. Over that last 10 years, the average U.S. Treasury yield is 2.2%. That is a negative rate of interest, real rate of interest of 50 basis points. Positive of 50 basis points. You subtract the yield, 2.2, minus the 1.7. Okay, so today we have 1.7 10-year or 1.6 10-year, and we have an inflation that's trying to get to 2%. Well, that would give us a negative yield. Well, how long are we going to have that negative yield? We can't have negative yields in a period of prosperity, growth, government stimulus, fiscal stimulus, and the things that Gillian is talking about. So as an investor, the backdrop here is rising rates secularly over time, and growth, but that will lead to periods of inflation. And those periods of inflation will hurt equities. They'll hurt bonds. So as an investor, fundamental investing is going to become more important. And the backdrop you have to assume is growth, higher inflation, higher interest rates.
So, Peter, one of the things I think that we've seen is that some companies have gotten away with, if not murder, close to it, because it's been so accommodative. The cost of capital has been almost zero. If you're right that we're going to have a world where we're going to have some cost of capital injected back into the business system once again, what does that say for an investor? How do you make sure you're in the companies that can weather that storm and out of the companies that can't?
Yeah, look, so I think that we've been in a period of time, really in the last pretty much 10 years of, I would call sort of cyclical rotations in particular industries, out of particular industries. Fundamental investing has had a role, but it hasn't been that significant a role. And we've also seen all this money move from active investing into passive, which has, been supportive of that process. I think as we exit this sort of, I'll call it government-induced increase in the markets, which has happened on the back of all the stimulus, we're going to start to see investors differentiate between companies that manage their capital well, companies that can grow in this environment, and companies that can't. And I personally think the fundamental investing is going to become more and more important. So as an investor, you need to be able to sit down and take apart a financial statement and really understand the business, look at the industry, understand the competitive set, see what the new competitors look like, see what new industries look like. There's going to be lots of change in we'll call it the roaring 20s. That happened in the 1920s. It's going to happen now. And there's going to be plenty of innovation, but that's going to require fundamental analysis to be able to take advantage of that.
Gillian, as you said, we've had enormous government intervention in the markets and into business. One place where they have been largely absent, actually, is in cryptocurrency, Bitcoin and the others, as a practical matter. Governments are not very involved in that. I know that you've had a panel with the Fed Chair, Jay Powell. You're writing on this for Financial Times. Give us your thoughts about whether the government, the U.S. government and others, will get more actively involved in cryptocurrency.
Well, at the start of the week, the Bank for International Settlements in Basel organized a so-called innovation conference, which might sound like a contradiction in terms because central bankers don't usually like to be seen to be innovating. But they had an innovation conference that, to my mind, was one of the most remarkable events I've taken part in recently. Because at that, Powell basically said that the Fed is now working with MIT to look at developing a digital dollar, or to use the jargon, a central bank digital currency, CBDC. And the BIS has done a survey which suggests that 2/3 of the world's central banks are now working on CBDCs. 14% of them already have pilot projects. The first one was in Bahamas. And China is racing to do this. So there's a lot of activity happening right now around this. Now, some people might say, well, hey, that's way too late. Some people might say, actually, this is kind of ridiculous because the whole point about things like Bitcoin is to try and disintermediate fiat currency and cope with the flaws in fiat currency. But what the central bank is essentially trying to do right now is a very mild version of, if you can't beat them, join them. They're almost trying to disintermediate the disintermediators and hope that by creating something like a digital currency, people won't even need or want to use things like Bitcoin or Facebook's Libra DM project, et cetera, et cetera. So it's very striking what's happening right now.
So, Peter, I worked for a wonderful CEO once named Tom Murphy, who ran Capital Cities ABC, and he used to say, I want to be the second into the innovation, not the first, because the first you can make some real mistakes. So as the United States, are we too early? Are we too late? Where are we in cryptocurrency?
Gillian's totally right. Bitcoin, took off as a disruptor. Basically, the contention was, who needs fiat currency? We don't trust the rest of the world. We're going to have this new currency that no one else can touch. We're going to run on this blockchain, it's a distributed ledger with miners all over the world, and it'll be completely independent. And a lot of people jumped on that train as sort of an interesting idea. But in terms of the size of that market, it's really kind of small. Now, it's gone up a lot and it gets lots of attention. But what it's really doing, and this is the key point that Gillian's getting at, and it's why, to your point, David, the second may not be so bad. What it's really doing is it's building an infrastructure to actually transact on.
Can I just jump in and say one more thing? Because I think Peter's completely correct. And I'm astonished that people are paying so much attention to Elon Musk's tweets about selling Tesla with Bitcoin and kind of ignoring this absolutely critical story. COVID-19 has accelerated this. And it's not just me saying this. Jay Powell on Monday said that COVID-19 has exposed the fundamental flaws in the global financial payment system.